All right, let's dive into a fascinating economic simulation. Picture this. It's 2026, and the US economy is surrounded by a massive wall of tariffs. But what if, almost overnight, that entire wall just came crashing down? We're going to unpack what could happen based on one detailed analysis. First, let's ground this in reality with a number that hits close to home: $1,500. That's the estimated price tag of this tariff wall for the average American family every single year. We're talking higher prices on pretty much everything you buy. So, the big question is, what if all of that just, poof, vanished? According to this report, we're not just talking about a minor policy tweak. This would be a genuine shockwave rattling the entire US economy. So, here's how we're going to break it all down. First, we'll get a handle on this great tariff wall. Then, we'll look at the surprising ways it could be torn down. After that, we'll explore the immediate economic shock, the wild ride for the markets, and finally, the inevitable hangover from this economic sugar high. Okay, first things first. What is this wall? Well, it's not just one single thing. The analysis paints a picture of a really complex, layered system of protectionism that's been built up by 2026, fundamentally rewiring how the US trades with the world. In this chart, wow, it really shows you the scale we're talking about. The average or effective tariff rate on stuff coming into the US is projected to leap from just 3% to a whopping 17%. That is a massive jump that would touch every single part of the economy. So how do you even get to 17%? Well, think of it like a layer cake of taxes. The base layer is a 10% tariff on basically everything. Then you stack a 50% tariff on top of that for key metals. Then you add another 25% on many foreign cars. And for China, you're looking at tariffs over 60%. It all adds up quick. And the analysis does not mince words here. It calls this whole structure the biggest functional tax hike on the American economy in more than 30 years. So, this is way more than just a trade policy. It's a huge fiscal event. Okay, so if this wall is such a big deal, how on earth could it ever come down? Well, the simulation we're looking at imagines a political shakeup after the 2026 midterm elections, and that could open up a few really interesting ways. Even with a divided government, the report lays out three potential paths. First, Congress could play hardball and attach changes to trade laws on bills that absolutely have to pass. Second, the Supreme Court could step in and just pull the legal rug out from under the whole thing. Or third, Congress could just vote to end the national emergencies that gave the tariffs their power in the first place. The report has a great name for that second scenario, a judicial deus ex machina. It's like a plot twist out of nowhere. A Supreme Court ruling could just vaporize the legal basis for these tariffs, and get this, it could force the government to refund billions of dollars already paid by importers. Talk about a shock to the system. So, the wall comes down. Now what? The analysis predicts an immediate sugar high for the economy. Suddenly, a powerful wave of, disinflation hits. Prices start falling, and it kicks off a temporary economic boom. And here's what that sugar high actually looks like in numbers. On the left, with tariffs, you've got inflation at a sticky 3.5%. But on the right, without them, it drops right to that 2% target. At the same time, economic growth jumps from 1.8% to a much healthier 2.5%. Lower prices, stronger growth. That's the sugar high. And where would these price drops actually come from? Well, the biggest piece of the pie is everyday stuff, things like clothes and electronics getting cheaper. But it's also businesses paying less for materials like steel and aluminum, and, of course, lower price tags on cars. But, a big economic shift like this isn't smooth sailing for everyone. The analysis does project job losses, especially in protected industries like manufacturing. But it also projects that even more jobs would be created in other areas that benefit from more trade. Think logistics, transportation, and retail. So, a net positive, but with some real pain in specific sectors. Now, this massive jolt to the real economy, you better believe it would send shockwaves through Wall Street. The report predicts what it calls a violent market rotation. Basically, investors would have to completely rethink their strategy, ditching the Fortress America playbook for a new one focused on global trade. So let's break down who wins and who loses here. It's a pretty clear picture. The winners, retailers, tech companies, and farmers all get a huge boost. Even the renewable energy sector benefits from cheaper parts. But there's a clear loser, the domestic metals industry, which suddenly loses its protective wall against global competition. And what about the US dollar? Well, it's expected to take a pretty significant hit. See, with no tariffs, Americans start buying more foreign goods, which sends more dollars flowing out of the country. The result is a predicted drop of about 5 to 8% in the dollar's value. So, who comes out on top in this new world of open trade and a weaker dollar? Well, the Mexican peso is seen as a huge winner. Same for other emerging market currencies. And back in the US, it's the big multinational companies and smaller businesses that are poised to do really well. It's a big shift. Okay, but you know what they say about a sugar high? It's always followed by a hangover. And in this whole scenario, that hangover is a big one. And it's all about the government's finances. The good times for consumers and markets come with a hefty price tag. And wow, is it a big price tag? We're talking about $2.8 trillion. That's the amount of money the federal government would lose over a decade once that tariff revenue disappears. That's like wiping out almost 1% of the entire U.S. economy's output year after year. So what does that actually mean? Well, you've basically just created a giant unfunded tax cut. To fill that massive hole in the budget, the U.S. Treasury would have no choice but to borrow trillions more dollars, issuing a whole lot of new debt. And that brings us to the absolute heart of this whole scenario. It's the core trade-off. You're swapping a tax that everyone pays on imported goods for a mountain of new government debt. The economy becomes more global, more friendly to consumers, but also a whole lot more in debt. Which leaves us with the million-dollar question, or maybe the $2.8 trillion question. You get a consumer boom, lower prices, and a more efficient global economy, but it's all paid for with a whole lot of government borrowing. So based on this deep dive analysis, is that trade-off actually worth it?